Hello and welcome to the Golden Eagle Eye on the Stock Market segment featuring macroeconomic and stock market commentary for the data-driven investor. We have Robert Zucchero with us, founder and CIO of Golden Eagle Strategies. Robert manages a strategy predicated on statistical analysis and principles derived from more than 40 years of research. Today, we look back at market recoveries after the bear markets of 1972, 2001, and 2008, and discuss how the outlook compares to 2022. Plus, we share one reason why investors may be selling stocks right now and how pricing power has shifted in today's inflationary environment as compared to 1974.
Much to talk about, some good, some not so good. Through December 9th, in looking at market recoveries, the S&P bottomed on October 12th. Through Friday, it was up 14%. Through yesterday, it was up 2%. Now it's down 3%. But it's still closer to bull market territory than bear market territory. The Dow has been the star this year. It's recovered nearly, 17% through last Friday. And prior to today, it was up 1.5%. The NASDAQ bottomed October 14th, along with the Russell 1000 Growth Index. And both of those indexes are still above their bottoms for the year. The Aggressive Growth Fund Index is slightly above its bottom on November 9th. The problem with these numbers really relates to the Aggressive Growth Fund Index, because in the past, it has turned up and turned down before the market as a whole. At the market turn last year, the S&P peaked on January 3rd of this year. The Aggressive Growth Index peaked 2 months before that in November. If you go back to the end of the bear market in 2008, 2009, it was a 2-year bear market bottom because the Aggressive Growth Fund Index bottomed and started its recovery in November of 2008, followed by the S&P 5 months later in March of 2009. So this data suggests that we haven't reached a market bottom. And if we are going to reach a market bottom, I would suspect if we go below the low points achieved so far this year, that the low points, if the market continues to erode, will take place in March or April of next year. Now, March is an interesting month because of 13 bear markets, 4 of them have bottomed in the month of March. What has knocked the market down today is something which I regard as silly. The retail sales report, which shows contraction of 6%. First of all, you can't believe government data. What could happen 30 days from now, when the government reports the retail sales number again, they may report that they revised it from -6 to 0.3%. Now, I talk about this all the time. What are the most relevant economic indicators that we look at? ISM. The which means non-manufacturing, is by far the most important of the 2 index that they report on. You have manufacturing and non-manufacturing, which is clever speak for service. Last month, the service index jumped from 54.4 to 56.6, indicating that the service sector is doing especially well in the current economic environment. And rightly or wrongly, the service sector really determines the direction of economic activity because it counts for 9 times as much as manufacturing. Manufacturing dropped by 1 point last month, dropped below 50, which indicates a contraction in activity. That's not a problem because it's a service sector that drives the U.S. economy. I would really put more weight on that than what is happening today. But clearly, the market is skittish. And one reason the market is skittish in December, I thought we'd have a Santa Claus rally. We started off with a nice rally in the first 2 days of this week. But right now, what is weighing on the stock market is something that has yet to be reported upon. In a year like 2008, toward the end of the year, like the end of this year, you have a lot of tax loss selling. Why are people selling their losing stocks? The reason they're selling their losing stocks is to harvest the losses which they can use against their tax filing for the year. I believe there's a lot of that going on, and nobody has yet commented on it. And the reason that we haven't had comments on it is you have to go all the way back to 2008, which is 13 years ago, where we had a market decline of similar magnitude or even serious magnitude. So we're not really hearing about that. The good news about a negative December is that all eyes should be on the month of January. If you look at history, and history is a very good guide when it comes to this, in 2008, the worst calendar year, not peak to trough, for the Aggressive Growth Fund Index, it dropped 44.8%. Over the next 2 years, how well did this index do? This is not the market as a whole. This is the AGFI, which is produced by Golden Eagle Strategies. I'll give you the answer. It doubled. It went up 100% in 2 years. And what you see in capital asset pricing theory, you see a number of things. The riskiest assets are the most rewarding over time. And the stocks that go up the most in a cycle and the up cycle go down the most in the down cycle. After the down cycle is over, the volatile stocks go up more. This is not going to change, is unlikely to change. In 1973-74, we had a decline of similar magnitude from peak to trough in this cycle starting in November of last year and ending in November of this year, 12-month period, the Aggressive Growth Index dropped by 54%. If you go back to 1973-74, it was a 2-year market decline. The Aggressive Growth Index dropped by 51%, and over the next 2 years, it was up 80%. So I would suspect that we're going to be looking at boxcar numbers over the next 2 years if past is prologue. Now, I purposely omitted the severe market decline of 2000 to 2002. The market peaked in March of 2000. It bottomed in October of 2002, but that was a very unusual bear market for this reason. The economy turned up in November of 2001. The economy actually turned up. What happened 2 months before that? 2 months before that, we had the World Trade Center buildings taken down, and this was the only bear market in post-World War II history where the economy turned 11 months in advance of the stock market. Most of you cannot recount what took place in 2001, the psychology back then, the melancholy back then, you can cut through with a knife. It underscores the mood of that day, which carried forward several years because Americans became disillusioned on the stock market, not only on the stock market, but also on their futures, because this was a cataclysmic event for all Americans. We were supposed to go away in November of that year to France, and we were so wrought about this. We canceled the trip. We didn't have to cancel the trip because the trip purveyor canceled it before we attempted to cancel it. But the mood was unlike anything that we've seen and probably unlike anything that we will see in the future, but it had a tremendous impact on that stock market, on that dramatically down bear market. And I don't think it's because of those circumstances. That experience is going to have a bearing on what's going to happen in going forward. So 73, 74 is a good indicator. 2008 is a good indicator, and they are only indicators. They are not gospel. Okay, on the economy as we sit here today and converse is growing. We continue to talk about recession, but one has yet to occur. Campbell Soup is a company that has been growing 2 to 3% per year. In the last quarter, they put up sales growth of 15% and profits growth of 15% based on the same unit growth. What is different about this economic cycle is said before that in the 1970s, when we had very rapid inflation, companies attempted to protect margins. In this cycle, because businesses are better managed than ever before at any time in history, they are not only raising prices in order to protect margins, but they are raising prices in order to expand margins. PepsiCo, which is a 3 to 5% grower, just reported sales growth of 9%, profits growth of 22%. Again, we have the same thing. In connection with Tyson Foods, they have raised several months ago beef prices by 30% and pork prices by 38%. So again, here's another instance of expanding prices. There are companies with the capability of doing this. And what this means is that the profits shortfall, should there be one in 2023, is going to be limited to single digits, which means that if we have a recession, the recession will be mild. If we have a mild recession, the stock market should not go down as much as it has done in the past in severe economic circumstances like 2008. Like 2000 to 2002 and 1973-74, which were the three worst experiences since World War II.
Thank you for joining us today for Golden Eagle Eye on the Market. For more information, visit our website at www.goldeneaglestrategies.com. Please note that the thoughts expressed in this podcast are those of the presenter. This is not, nor should it be considered, an offer or a solicitation of an offer for investment.